the best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin Jeong. Successful investing is about knowing what to avoid rather than what to chase. That's what Warren Buffett previously said. Warren Buffett, often referred to as one of the greatest investors of all time, has consistently built his fortune on principles of value investing, patience, and a deep understanding of the businesses he invests in. As more retail investors seek to navigate the complexities of today's market, many wonder, can Buffett's timeless investment wisdom still be applied effectively in our rapidly changing economic environment? Is his strategy still relevant? And if so, how can investors, both seasoned and new, incorporate it into their own portfolios? And how can Buffett's core philosophies on investing be applied in the Singaporean context? Well, to find out more, joining me now is Steve Alain Lawrence, who is the CIO of Balfour Capital Group. Steve, welcome to the show.
Thank you for having me here, and it's going to be a very exciting topic with the dynamics of what's going on in the markets right now.
Right.
And I'm really excited to talk about this.
Yeah, I'm super excited to talk about it as well, given that Warren Buffett also announced his retirement earlier this year, right?
Listen, to be 94 years old and go on to, and actually make a presentation in front of over 30,000 people can say something about the philosophy that he does and why he does it. But what I can tell you is this: the simple thinking is also the long-term thinking. And I think that's the hardest that any viewer needs to understand.
So let's dive into it. Looking at the current market landscape, though, through Warren Buffett's eyes here, what opportunities and risk would he likely see today?
I can't speak for Warren Buffett, but what I can definitively tell you is that he has put the right team in place. Okay. The idea of understanding an industry with people. Every industry is about people. He's always bought industries about people and the long-term vertical of what it is.
Right.
So when you see that, and when you see this type of volatility, whether it's technology, whether it's AI, it's truly trying to encompass all the interconnections between people. You're not going to find anybody better than that. It's a fact.
Right.
All right. And using, the idea of value investing. Can you be in it for 10 years? So where will NVIDIA be 20 years from now? Where will Meta be 20 years from now? Where will the Hang Seng be 30 years from now?
That's true.
That's a hard thing.
Right. Well, when it comes to Warren Buffett, as you've mentioned, one of his key philosophies is, long-term value investing. But some have even questioned whether or not the long-term investing philosophy even works in today's market landscape. So how can retail investors kind of adapt Buffett's long-term value investing philosophy in today's fast-paced and volatile markets?
Let me say this to you, okay? The idea that endorphins work so quickly, whether it's TikTok or whether it's YouTube or any type of media that comes into the endorphins to the consumer, what you will see is this, and the viewers need to understand this. Trust equals time, and time equals trust. And that's going to and that is the key to any investment strategy, period, end of story. You invest in people, okay? So he was able to discern that. And of course the philosophy is the same.
Well, speaking of trust here, one of the biggest takeaways from Warren Buffett's investment philosophy is invest in what you understand, right? How can retail investors realistically apply Buffett's invest in what you understand principle in an increasingly complex and tech-driven market?
Great question. When it comes into the tech-driven market, what you need to understand is this. When you look at a company, let's say, for example, like TikTok, or what's the difference between TikTok and Intel and Bitcoin? Not much.
Right.
No, there really isn't. At the end of the day, they're all correlated with the algorithmic ideas of what it means. So when you understand something, when you have passion for it, if you like fashion, you understand it, understand the difference between Aloe and Lululemon. That's the real takeaway from it. As far as an investor, they've got to just realize the reality of what it is, okay? Volatility tells you two things, fear and greed.
That's true.
So when you're afraid, only invest in something that you may or may not understand. But if you invest $1, understand that you might have to invest 20 cents over the long term. That is the philosophy of Buffett.
I mean, there's always this concept of FOMO or fear of missing out amongst retail investors, especially the new retail investors. So what would you say to them, and how would we apply Warren Buffett's philosophies to avoid this emotion-driven fear of missing out kind of investments?
Let me say this. I've been in these markets since 1989. In the very beginning, okay, all right, he didn't even invest in technology stocks. And at the end of the day, he invested in Apple and all these things. The moral to the story is this, is when you invest in something that you may or may not understand, you don't have to put the whole kit and caboodle in. Understand who you are of what you can understand with risk. It's not about how much you can make, it's always how much you can lose. And the long-term approach of how you want to feel comfortable with yourself as an investor. Don't ever invest in something that you can't afford to lose.
Okay. Well, Buffett famously advises holding investments forever, right? So how practical is this approach for retail investors in the current market environment, though? Is long-term investing still the right approach?
Let me say this to you, and let me correct you categorically. He's never said to invest forever. No one has. What he's specifically said is that you can get into a strategy and over the long term get out. There's nothing forever. If he owns something forever, okay, like Coca-Cola, his exposure is so limited because he did it a long time ago. So he can, let his profits run and cut his losses short. And he's the first guy that's going to tell you, when you understand Benjamin Graham, all right, the idea of understanding valuation, okay, you're not going to see the dichotomy or the separation between value. Value is value, and perception is value. And that's why psychology is so critical in what it is for the long term.
Right. Well, for new investors in particular, choosing a specific stock to invest in may be a challenge. So which ETFs or stock screeners could help retail investors build a, so-called Buffett-style portfolio without needing to pick individual stocks?
Well, let me say this. You can always buy an index, okay? And the index processes got started by the Honorable Ben Vogel. And understanding how indexes are worked, okay, you could always invest in the index itself for the long term. So if you're afraid, you're going to say, hey, I don't know much about the stock market, and I'm going to buy the index, okay, for the next 20 years. And I think the key component for anyone who's successful is focus on what they know, meaning their own business. The market is only a little part of your long-term portfolio for who you are and what you do.
Okay, so let's take a look now in a more Singaporean context here. Steve, can Buffett's principle of investing in strong cash-generating businesses be applied to Singapore-listed companies, many of which are in REITs, banks, and consumer sectors?
Anything to do with cash flow models, and let's say, for example, Singapore, which is a hub. Singapore is the baby Wall Street, okay, for Asia. But at the same time, it's on equal footing with Wall Street, okay? If you understand Singapore a little bit, the Chicago Mercantile Exchange started the CIMEX, which is the whole derivative markets here. Okay, so when professionals like myself, who've been in the business for many years, okay, the new dogs need to learn the old tricks, and the old dogs need to learn the new tricks. Okay, so it's a combination of understanding not only the social media, but the valuations of what it is. Singapore will go higher. The industry and the hub of what it's made, all right, for fintech is unbelievable.
All right. Well, then what characteristics should Singaporean investors look for when identifying companies with economic moats in the local context?
In the local context like this, okay, making an investment in places like Indonesia or Vietnam, buyer beware. Okay, buyer beware. Like any other market, buyer beware. Woulda, shoulda, coulda. When you're developing into new markets, okay, and when you're going into markets that are strategically difficult, what the investor needs to understand is how they can sustain the long term of it. It's not putting on an investment saying, I'm going to make $1 million. It's like, okay, if I can get into, let's say, the beer company or the real Fortune 100 or 50 companies in this sector, I can go to bed at night. But if you want to bet on black, you're better off going to a casino.
Okay, makes sense. Well, Buffett emphasizes long-term holding of high-quality stocks. So in a market like Singapore, which is known for, lower growth but higher dividends, how should investors balance growth and income?
One of the things that the Singaporean and the public should need to understand is, as Singapore is a hub, it's much more than just Singapore and the conduits that they have. In a country like Singapore, you have access truly to the world. Right. And I think that much of the public doesn't understand that they have true access to the globe. So it's so much more than just Singapore, all right, as far as the conduit and the companies. Understanding the specific companies in Singapore, you're going to always have to deal with two things, okay? The banks and the real estate. Remember, it's a relatively small population. Money aside, put that aside. It's truly about the reality of what it is. It's a conduit of technology, high net worth, and a society that understands all the Asian cultures, and that's why they're the Wall Street of Asia.
Okay, Wall Street of Asia. Well, are there any companies on the SGX that fit Buffett's definition of wonderful businesses at fair prices? I mean, what industries or sectors should investors look towards in the Singapore market?
In the Singapore market, exactly. Anything to do with pharma.
Pharma? Why is that so?
When something is out of vogue, okay, one of the things that the public may or may not understand is that pharma is and long-term care is so critical in the Asian culture, in many cultures, okay? And what you will see, whether it's a nursing home facility or whether it is a facility that can repair people, okay, if they got a bad knee, it's a big part of the culture about taking care of yourself mentally and physically. And many other cultures don't have those components. So, and as far as the real estate sector, okay, and just walk around Singapore. Everything's full.
Well, then, talking about the real estate sector, I mean, Singapore has a strong REIT market here. Would Buffett, if focused on Singapore, likely invest in REITs, and how would he evaluate them?
Listen, talking about Buffett specifically in his philosophy's always changed. And what I will say to you categorically and definitively is that this. Understanding value is value. Okay, when there's fear, people step into the market. Of course there's opportunity in Asia, especially in places like mainland China. And the public truly doesn't understand that.
Why do you think the public doesn't really understand that?
Because it's a natural thing. When everyone sees something that's going down, they get nervous. And why would they? Okay? I mean, they see, hey, it's not a good buy. Okay? All right? Is at the bottom. There'll always be value to certain things. And that is the hardest part about understanding yourself as an investor, is understanding your own fear. Don't ever invest in something that you can't afford to lose.
That's some great advice. Well, before we let you go here, Steve, if there's one core principle from Warren Buffett's philosophy that investors should always keep in mind, what would it be and why is it so important?
I think when you look at Benjamin Graham and when you look at Buffett and when you look at the whole concept of investing in value, when you look at the core philosophy, he's always invested in what? People. That's it. That's it. Okay. He invested in people when he did it in Coca-Cola. All right. It took him years to invest in Gates. It took him years to understand Microsoft and Apple. If you look back at his old interviews, he only invested in what he understood it. But I think the most critical aspect of it, he was always truthful to himself. What I don't understand, I don't do.
Right. And of course, investing in people is very, very important. Well, thank you so much, Steve, for joining me today.
Why, thank you for having me here.
Thank you.
Awesome.
Thank you. That was Steve Alain Lawrence, who is the CIO of Balfour Capital Group. This has been the Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.